We have in the previous two sessions seen the basics and the accounting concepts, and thereafter we went on to see the various types of records such as the source documents as well as the books of prime entry. Now we move on to what I would consider a very core of the accounting profession, and the understanding of this particular part of accounting is extremely important for us to progress to the advanced levels. Now what we are going to then discuss now is what is known as the double entry system, and I will give you a background to this double entry system which forms actually the backbone of the whole accounting process. Do not get too worried, as we go on it will become very clear. Now let me start off with what are our session objectives going to be. As I said, the accounting equation in this whole session is going to sit right on the top, and it is going to kind of be the umbrella under which we are going to understand all the other concepts that are mentioned out here. We will see why do we need something called a ledger account. We will also see as to what a double entry bookkeeping means. It will actually flow from the accounting equations. As we go through, we will understand that. From there we will come to the other book of prime entry, which we said in the last session we will discuss at the in a later time, is the journal. We will also look at how journal and ledger are related. Initially we will just understand why ledger, and then actually look at it in a little more detail in conjunction with journal, and thereafter we will see how the books of prime entry also lend itself to the double entry bookkeeping system. So that is the overall objective, and we will get started by understanding first why do we need something called ledger account. The basic objective is pretty simple. We have recorded, as we saw previously, all these transactions in a chronological fashion as and when they happen in the sales day book or the purchase day book or the cash book, all these books of prime entry. But as you know, as the transactions are happening, they are in a chronological fashion, and suppose at any point in time I have a question like, what are the total travel expenses incurred? I mean, I need to now go on adding the various travel related expenses, maybe from the cash book or the bank book, and then work out what it is. Or for example, how much due is to the bank on the term loan taken. I may not even have a queue given the books of prime entry. And also how much, say for example, is due from a customer. If I look at the sales day book, I need to again find out which are these customers who have still not paid, etc., etc. So customer wise, can I get an idea? Basically all these kind of questions will be addressed through what are known as ledger accounts. But before we move in, as I said before, we need to understand a very key and important concept called the accounting equation, which sits on top of all that we are going to discuss. Basically, accounting equation states that the assets of a business must be equal to its liabilities, period. I mean, there is no two questions, there is no argument about it, that assets of a business must be equal to its liabilities. Now let me just take an example of somebody starting a business and see how this equation works out as more and more transactions happen. My suggestion and a request to you who are watching this is to take a paper and a note and note down some of the figures that we will be mentioning from time to time as we progress with this business scenario, so that as we go on you are able to relate the figures to the overall framework in which they are being explained. So please do that. Now let us look at what this business is. This is a business of spices which Ram has started, and he has put in a capital, his own money, into the business of 2,50,000 rupees. So now what is the accounting equation as far as that business is concerned? Now this will look like something like this, as to total liabilities is 2,50,000 and total assets, which is in the form of cash which Ram has brought in, is 2 lakhs 50. This is easily be understandable, but may ask you, what is this? Is the business entity concept that we are talking about here. Once money has been put into the business by Ram, the business is a separate entity as far as the accounting is concerned. So to Ram, it owes 2 lakh, the business owes 2 lakh 50,000 rupees. So that is the liability, and the asset is the cash balance that is there in the business. Another way of looking at it is that who has funded this and where is that money lying. There is another way of looking at it. Now I can split this liability part into two parts. One, what is the owner's own money that has been put in, also called as owner's equity, and what are the outside liabilities that have come in, and combined together they should represent the assets. So when Ram started business, he has not taken any loan, so your outside liability is 0, while his own input into the business has been 2 lakh 50,000, which is owner's equity. So we have the same thing represented as owner's equity plus outside liabilities is equal to the assets of the business, which is what this equation shows you. Let's now start doing some transactions. Ram now purchases a stall. Now he started a business. A friend of his was retiring from the business, so he picked up a stall from him in a marketplace and paid him 1,80,000 rupees for that. And then he went on to buy herbs and spices which he is going to trade in, which is going to sell from the wholesale market for 65,000 rupees. So he had put in into the business 2,50,000 rupees. Now he has spent 1,80,000 on the stall, 65,000 rupees on buying the goods that he is going to sell for his business, and it leaves a cash balance with him of 5,000 rupees. He puts about 3,000 rupees into the bank and keeps 2,000 as a float for his regular expenses. So on the first day of the business, as he started this business, how does it look like? The asset and the liability, or so called accounting equation. So what happened? What was a cash asset of 2,50,000 has got converted into a stall of 1,80,000. His herbs and spices, or the traded goods that he has bought, of 65,000. He has put into the bank 3,000, and now the cash in hand is only 2,000. So what was cash in hand of 2,50,000 as assets has got split into different assets now, still totaling to 2,50,000, and his liability of this business to Ram still remains at 2,50,000. There is no additional loan or money that Ram has put in. So this is how the equation. So we see that after these transactions, the assets and the liabilities, which is capital plus outside liabilities, are still equal to the assets. Now let's add on a few more transactions. What does Ram do? Ram has had a very successful day. He sells his 65,000 rupees worth of herbs and spices for 90,000 rupees on that day, making a profit of 25,000 rupees. So now this money Ram did not take out as profit and started spending it for his personal needs. He kept it in the business. So what happens to the asset and liability, or the accounting equation? The stall remains as it is, so there is no change, but the herbs and spices, which was valued at 65,000 rupees, has now got sold off. So there is no balance there, but that has got converted into cash. So the cash has flown in, but what is the cash that is flown in? Because the sale price was 90,000 rupees. So 90,000 rupees has flown in, and his old bank balance was 3,000, and the cash in hand was 2,000. The total cash and bank balance that he has after selling is 95,000. So that is the asset side. So what is the difference then between what his cost price and selling price was? That is the profit of 25,000. That 25,000 becomes a liability of the business to Ram as the capital that has got added to the original capital that has been brought in. That is called as the profit retained in the business. Instead of bringing another 25,000 from outside, Ram has decided the profit that he has made is going back into the business. So this then the business owes to Ram. So you add up the two, you get that now the asset and the liabilities have become 2,75,000 each after this transaction. So again we see that this accounting equation is maintained. There is a dual effect, or there is a two-way effect of the transactions as they happen. Let's add on a little more on this.